G'day there viewers and welcome to Chapter 3. We're following Osborne books, so let's get started. The objectives for today are: why are 2 accounting entries needed? What are the stages of the accounts? The ledgers, we're going to take a quick look at the ledgers, the T accounts, looking at example entries and balancing accounts. So let's have a look at the accounting equation. So the accounting equation basically says assets minus liabilities equals capital. So if you put the liabilities on the other side, it will be liabilities plus capital equals assets. So if you think about it, that's true. The assets had to come from somewhere, so they either had to come from the capital from the owner or liabilities or a bank loan that you took out. So liabilities plus capital equals assets is another way to rearrange the equation. So owner introduced £100 into the business, so the capital will increase by £100 and the assets will increase by £100. So why are 2 accounting entries needed? Well, something has been introduced, so one side of the account has gone up, the equation has gone up, so the other side of the equation has to go up by the same amount. So capital has increased by £100, so the assets has increased by £100 as well. Okay, so for every entry, because there's 2 sides of this equation, just like any equation, one side goes up, the other side has to go up as well by the same amount. If the assets decrease by £100, then another asset would have to increase by the same amount for the equation to still be equal. And the other similar entries will be true too. So 2 entries are always needed because one would mean that the accounting equation would no longer balance. So let's have a look at some stages of the accounting. We've already looked at this in Chapter 1. So what we're going to be looking at today mainly is documents, book of prime entry and ledger accounts. So we're going to basically be looking at ledger accounts mainly, double entry system. Before we looked at these in Chapter 1 a bit more, but today we're only going to be really looking at the ledger accounts. So what are the ledger accounts? The usual ledgers. Bit of a pun on the word ledgers, and sorry, not on the word ledger, sorry, on the because these books are usual in the accounting system, so a bit of a pun on the word usual. So ledgers. Now ledgers means the books, and it's an old word for the word books. So we've got the sales ledger, we've got the purchase ledger, we've got the main ledger. So the main ledger is basically all the accounts, the T accounts in your accounting system. So you might have a motor vehicles account, you might have an account for buildings, etc. Liabilities, you might have bank loan account, trade payables, expense accounts, so wages, any other purchases, any other expense accounts like that. Income accounts, so all the income accounts such as sales, other types of sales income, revenue income and other income, miscellaneous income. So let's have a look at this. Double entry accounts. So you've got this is your basic T account. So it could be any account where you purchases anything that you like. So what this T represents is the 2 sides of like a book. So this would be like the left hand side of a book. This will be the right hand side of a book. The debit is on the left hand side and the credit is on the right hand side, and then you make entries into this side or this side depending on whether they're debits or credits. So which ones are debits or credits? So if you look, remember from Chapter 1, debits are assets, expenses and drawings, and credits are liabilities, income and capital. So you can use the acronym DEDCLIP to remember these, or you can use the extended accounting equation as well. That's the way I like to use it. Assets plus expenses plus drawings equals capital, income and liabilities. So the accounting equation, we had a look at this before in Chapter 1. So if you increase one side, you increase the other side by the same amount. So let's have a look at another entry to that. So this time £50 is spent on equipment. So an asset, the cash in the bank, has reduced by £50. So another asset, equipment, has increased by £50. So the accounting equation still balances, and this is the basis of accounting basically. So pay insurance expense £100. So here, what kind of entries do you think that you'll see in the T accounts? Well, expense is a debit, so we'll see debit expense £100. And in the if you pay an expense, you normally pay it out of the bank, unless it's on credit. Credit, remember, means you pay later. So here we're going to see that on the left-hand side, which is a credit to the bank. So have a look at that. Yeah, that's what the answer is. So expense is debited and bank is credited. So payment of wages. Now that's another expense account, so that will be debited. And which one will be credited? It will be the bank. Let's have a look at that. Yeah, so the bank is credited and the wages expense account is debited and the bank is credited. So which account is debited and credited here? A cash sale for £300. Now a cash sale is different from a credit sale, because a credit sale the customer will pay later. Let's have a look at that one. If it's a cash, we'll go to the bank and we debit to the bank, because it will be an increase of cash of £30. And an income is a sales, so that will be credited with £300. So sales income is credited £300. The bank asset is increased by £300. Motor vehicle asset and cash is paid by in cash. So which accounts will be debited and credited here? Well, we know if it's an asset, you have to debit it to increase it. So we put £10,000 in cash in the motor vehicles account, and then if you credit, if you pay by cash, then you have to credit the bank with £10,000. So let's have a look at that. Yep, the bank is credited with £10,000. The motor vehicles account is debited with £10,000 as well. So here we've got a credit purchase. Remember, credit means that you pay later. So here there's going to be no entries into the bank. So goods for resale for £3,000. So goods for resale, that's a purchase. So purchases will increase by £3,000. Purchases is a expense account, so that will be debit. Purchases £3,000, and then the credit will go to purchase ledger control. And we've not seen this before. Purchase ledger control is a creditor account, it will be go to the creditors 3,000 or purchase ledger control. Creditors, remember, is the old name for the purchase ledger control. So here let's have a look at this. The creditors or purchase ledger control is credited with £3,000, and the purchase is debited with because it's expense with £3,000. So here we've got a credit sale of £300. So which accounts do you think will be debited and credited here? So we've already gone to the answer. So let's have a look at that. So credit sale is a sale, so the credit side of the income account would increase by £300. So it would be credited to the income, and then it will be debited to if it's a sale, it will be sales ledger control, which is the old, which is the new name for debtors. So now we call them debtors, really. Sorry, now we call it sales ledger control, but they're basically debtors, people that owe you money. So £300 to the sales ledger control, and £300 to the sales income account. Okay, thank you for listening. We'll stop there and carry on the lesson in another lesson. Thank you.